Welcome out to the Blue Sky Trading Lab. This is Coach Matt. I am your coach here today and obviously each and every Thursday during this lab. And, the topic this week that I really kind of wanted to discuss is the conversation of moving averages. As our goal every single week in this lab is to increase financial IQ little by little by little. My topic I chose this week is the concept of moving averages. And I just want to kind of get an understanding of how well you guys understand how to use moving averages. From just like give me an just an overall understanding of where your level is. Do you and scale it 0 to 10? 0, you know nothing. 10, you're a wizard. How well do you understand how to use moving averages in your trading? Nacho -10. Woji 6. Patricia, like I really love moving averages. Gabby, you're 6. Everybody answer here. What's up, Matt? Good to see you, brother. Let Anon and Nacho finish typing here. Working your way up there, Nacho. Listen, we all got to start somewhere, my friend. We all got to start somewhere. Moving averages, in my estimation, are a very, very simple tool. Um, when things can get complicated out there in the world, there are tools you can use to kind of smooth out some of that volatility to get a better read. And when I was a young trader, I didn't really believe in moving averages, guys. It's not that I wasn't familiar with them. The way they were used back in the day was primarily based on crossovers and trend following tools. And I never really felt like I needed the training wheels called moving averages to understand the direction of a trend. I never really felt I needed them to understand the momentum of a trend. And so you had trend following tools, and then you had basically crossovers. And I didn't love crossovers because I felt they were lagging the actual trigger mechanism on a trade. And so I didn't love moving averages. I didn't feel they were magic lines and they didn't provide any value. I just didn't really feel the need personally to use moving averages as a secondary confirmation tool. I didn't see the need to use them as a primary confirmation tool. I felt there were better, more accurate ways to navigate those ultimate questions that moving averages helped answer that were more accurate, such as, for example, potential average yield and other levels of support and resistance. However, when I first started trading, guys, it was back in 2005. And in 2005, what percentage of the overall market landscape was dominated based on moving averages? Like, if there's 100 trades put into the market, how many of them were based, not moving averages, but based on algorithms? So out of every 100 trades in the market back in 2005, how much were based on algorithms? It was between 5 and 10%. It was depending on who you ask, but it was about 5 to 10%. But it was primarily at the market makers, right? Entities like Citadel, for example. But it was very, very little. And because it was very, very little, I didn't feel moving averages were that important to me. 10 years later, that was around 70%. What percentage of orders that go into the market today are based on some degree of algo program? It's anywhere depending on the day between 90 and 95 is kind of where the number is. And those moving averages have to be programmed. And when you think about the programming, not a movie, but those when you think about the programming of an algorithm, The simplest way to program anything out there in the market is using two moving averages. When you think about RSI is a moving average calculation. When you think about MACD, MACD is a moving average calculation. When you think of stochastics is a moving average calculation. And so when you think about those early indicators that were designed in the 70s and 80s that dominated the landscape, even up until today, those all use moving averages. When you think about the algorithms that are programmed to trade today, algos are programmed for the by and far for the most part. You can go out there and find some marketing agency saying we have the greatest algorithm in the history of mankind, and the only thing it is a moving average. That's it. That's it. That's all. That's all it is. They're I shouldn't say they're all, but the vast majority of those algorithms are programmed based on moving averages. And so moving averages have simply taken on a much greater emphasis in the overall technical landscape today than they have at any other point. And Patricia, you make a wonderful point. There are magnets in the market. There is no doubt about that. And there are certain moving averages that will work as a magnet. Now, I don't know about your 420 EMA. I don't personally use that. I'm more of a traditionalist from a moving average perspective. In fact, I don't even recommend using non-traditional moving averages because my belief in technical analysis is, quite frankly, it works because other people use them. And yes, I do get the joke there, Infinity. I don't use that moving average either. You move the six, I definitely use a nine. There's no doubt about that. I do love the nine EMA. There's no doubt about that, mate. So let's talk about moving averages. And what I want to do, guys, is just kind of just do a nice little, definition of moving averages. What are the major moving averages people use? What are the most traditional moving averages? What are the fast moving averages? What are the slow moving averages? What's the difference between EMAs, SMAs? How we use them? Now, in the way people use moving averages, I want everybody to list me out one major reason why you use moving averages. If you do. And if you don't, just say I don't. That's fine too. What is one reason why you use moving averages? Because they are very multi-layered. Anon, I use moving averages to understand what other systems are doing. Good. I'll give you guys some time here. MACD. Well, and MACD does use moving averages, but the moving averages that I'm talking about, Nacho, are not within an indicator. William, overall bias, that would kind of go towards trending, turning points, that would go to crossovers. And those are kind of the two traditional ways to use them. I don't use them as much like that today, but those are two very traditional ways. Magnets, Patricia, that would be another word for support and resistance, rejections, direction of confirmation, combo Bollinger Band. Love all of that. Absolutely. Can we all agree that different traders can use moving averages in a different way? Can we all agree with that? Like they're multifaceted, they're multi-layered. Different traders will use them for different purposes. And so let's get to know them just a little bit here. Now, you have two basic types of moving averages, team. You have EMAs and you have SMAs. Now, the difference is how they are calculated. So, for example, an SMA is calculated simply by looking at the average closing price over time. And so, when we're doing, say, the 20 period moving average, or the 50 period moving average, or the 200 period moving average, or the 420 period moving average, or the 69 moving average, whatever you want to use out there, whatever that is, it is an average close over time. Okay. The difference between a simple moving average and an exponential moving average is the exponential moving average gives much greater credence what is happening right now. And so it weights the calculation to what is happening right now, which means EMAs versus SMAs, which one would be more well utilized for momentum style trading? Would that be EMAs, which are quicker to the read, or would that be SMAs, which are a little bit slower to the read? It'd be the EMAs, right? It would be the EMAs. And so EMAs are a little bit faster, SMAs are a little bit slower. And so when you look at these moving averages, the difference, for example, between an 8 SMA and an 8 EMA is even though they calculate on the exact same time frame, the EMA will always be more sensitive to volatility because it gives greater weight to what is happening right now versus what happened 9 days ago. Whereas the SMA says, I don't care what happened today versus 9 days ago. I am going to weight them all equally. They all matter identically in that way. And so you have EMAs versus SMAs, but you also have to think about it from a what are those moving averages that we use for short-term trading, meaning we don't have as much lag in the price, versus what are those more longer duration moving averages that are more used on longer duration type of holding patterns. So whether you're a day trader or a swing trader or a position trader, they're both used for those purposes. Short term is less lag, longer term is a little bit more lag. So the moving averages that I personally utilize to determine the faster kind of analysis is I'd like to look at two different moving averages on a very short time frame, the 5 EMA and the 9 EMA. The 5 EMA and the 9 EMA are two very, very aggressively programmed moving averages. The pocket between the 5 and the 9, that is what we refer to as the hard 14. That is a support and a resistance zone that attracts a lot of price. And so when you're dealing with momentum conditions and you're dealing with momentum pullbacks, such as like a flag-based pattern, oftentimes those flags will find that combo between the 5 and the 9 before it continues to move in the direction of the prevailing trend. And so the 5 and the 9 is the two really aggressive EMAs that are used in a lot of short-term type trading, whether you're talking day trading or swing trading, really doesn't matter to me because it's going to be a very, very, very similar technique. The only difference would be really kind of the time frame that you are looking there. And so the 5 and the 9 combo is the two shorter duration moving averages on the EMA side that I like to utilize to really kind of help me understand the momentum support zones, the momentum resistance zones. I'm not really using it from a crossover perspective. I'm not suggesting that when the 5 EMA crosses on top of the 9, that is the ultimate buy signal, although that is a short-term buy signal. Same thing when the 5 EMA crosses over against the 9 EMA, that would be an identification of a short-term sell signal. How I personally utilize the 5 and the 9 combo is to help me understand momentum support zones and momentum resistance zones, given the fact that I believe that the 9 EMA is the number one momentum indicator in the market. And personally, I don't find there to be a compelling second argument. I really don't. It's not that I won't listen to those compelling second other arguments that other technicians have to say, no, I love this momentum indicator or I love that momentum indicator. To each their own. What I will suggest is based on my back testing and study and understanding of this conversation, the 9 EMA is very, very, very consistent from a support and resistance perspective. Yeah, Patricia, I agree with that. I don't like it's not good when you have two really tight moving averages working as crossovers. You're not creating enough room to really kind of work with that. And that was kind of my larger point is I don't think you want to really kind of use two aggressive moving averages through a crossover way. You want to kind of expand that out a little bit more to get a better momentum trigger on that, I would say. 100% agree with you. The 5-9 combo is not used for a crossover specifically. The 5-9 combo is used as a momentum support level or a momentum resistance level. So you see when the price gets down into the in between the two levels here, price gets in between the two levels, price gets in between the two levels, price gets in between the two levels. That's that number one kind of the 9 EMA being that, but the zone is between the 5 and the 9. I agree with you 100%. If you are going to use crossovers, it's much better to create those crossovers that create a little bit of lag in between the two numbers. That allows the price to kind of live and give you a better confirmation signal on that. These would be two EMAs of very tight time frames, and you're trying to understand that zone because when you talk about support as a day trader, and it's properly so. You just say it's a number, right? You don't say the 240 zone. You just say 240. But support is not a finite number. Do we all understand that, by the way? Support is not a finite number. Resistance is not a finite number. Like I need to make sure everybody understands that, guys. Because I do hear quite a bit of times where people talk in finite numbers when support and resistance is not finite. Support and resistance is a zone around that level. Before we had fancy computer programs to plot different areas of support and resistance, the old school traders who would draw their own charts, they would use a big thick marker to identify the support zone because it's not a finite number. So what I'm trying to do here is I'm trying to understand that zone of support where those buyers could step into, not in terms of that finite solution, but that zone of support. Does that make sense, everybody? Why the 5 and the 9 combo there? Awesome. Okay. So, for example, let's come into the market here today and let's look at the ES and let's go into the 15-minute chart here. Now, let's plot. I got to bring in my 5 EMA. I apologize. Let's remove all these other indicators. Let's remove all those other moving averages. And let's just do a exponential. Where are you, exponential? There you are. Exponential moving average. I'm just going to hurry and modify it to the 5 EMA. And I'm going to color it white because that's what my 5 EMA is. Bring in the 9. So you'll see I got the 5 and the 9 here. Now, when you see kind of like the overnight session here, look at this overnight session, guys. The momentum conditions. Every time it gets into that 5, what occurs? Every time it gets into that 5, what occurs? It's because that zone, the 5 EMA is tracking the price very, very closely. And so it's always going to kind of be in that number. And so when you see that kind of in that 5 and that 9, you're riding the momentum down. You're riding the momentum down there. That's why I love the visual look here because it tells me where this zone is. And then do you see when the 5 starts expanding against the 9, you're seeing the momentum expand there, showing you the momentum's very consistent here, very consistent, very consistent. Every time it gets into that, it's a sell. You see that kind of work out. Now, once the 5 starts kind of flatlining here, the momentum is kind of turning around a little bit. And when moving averages are flat, guys, you shouldn't take a lot in terms of the analysis when moving averages are flat. Moving averages are moving. They need to be moving to be a big part of the conversation. And so you don't want to get too caught up in this neutrality here. But when you see this market break out, and it broke out right here during the London session here. Once it breaks out, once again, look as the market expands its momentum on the first pattern that kind of identifies here. This is a high base. And so you see how you start pumping here, high base. What catches up? The 5-9 combo. Once that price gets into there, all of a sudden the buyer starts stepping up a little bit. Momentum starts to expand, starts to expand, starts to expand. Once again, gets into that five, you know you're at support again. What you would expect is a little bit of that to work out. Doesn't gets under the nine. Once it gets under the nine, momentum is shifted. So once it gets under the nine here, and you give up that momentum condition, you no longer can use this momentum to justify your trading decisions. That momentum is over the very second this candle right here closes underneath that nine, because now you're in a different situation. And so you ride that lightning there until it changes here. Once it changes, you got to adapt with that. You got to modify with that. You got to change with that. Now, that's not unheard of going into the US Cash Open. We obviously get quite a bit of volatility during the US Cash Open. Um, no, it would be, you could certainly, if you're plotting it on the 15 and you just know where the number is, Patricia, then the five underneath that would be a very good early indicator. Yes. But based on moving averages, and I will talk about this concept next week, it's called pull. Everybody write that word down. Pull, Pull. I believe it was Patricia, you said moving averages act as gravity. They act as a magnet to a certain extent. And so, yes, you can look at the 5 minute chart to get an early signal that it is closing underneath that 15-minute nine, if that's what you're tracking on your trade, right? But but at the same time, I don't really want to modify that on moving averages because of the concept called pull. Moving averages have a very unique way, and we saw it literally on the close here today, to kind of close around where the average is. And so I don't really want to kind of flip time frames yet to get a better edge on that signal, because it could be very easily a fake out signal. And so I really kind of want to be rigid against the time frames I'm looking at, but that is a very, very good question, because in other versions of technical analysis, like when you're tracking a 15-minute breakout channel, for example, it's very customary to go down to the 5 minute chart to get a cleaner entry, no doubt about that. So I love where your head's at. But when you're dealing with moving averages, they're so unique to their specific time frame that I wouldn't really kind of switch the time frames necessarily yet, just to get an early read on the momentum shifting there. Does that make sense? Amaro, I oftentimes will trail on the 15-minute 9 EMA. And so, like for example, I didn't catch this trade last night. I was kind of, I saw it, but I was going to bed. And so I didn't catch this trade. But if I did, I guarantee my philosophy would have been one thing: ride the nine. As long as that stays above the five. And on that one, Patricia, I would, like, in this consolidation pattern, I would go to the 5 minute chart to get a pristine entry, but I would flip it back to the 15 to really kind of understand my management here, because I love trailing a stop loss on the 15-minute time frame. Absolutely, absolutely. Um, no, no, I do too, Patricia. I just don't switch the to a 5 minute chart to determine whether or not it's going to be an early entry against a 15-minute moving average. I absolutely will switch to the 5 minute on pure technicals here. No doubt about that. Gabby, yes, you can. Yes, you can. Yes, you can. And I thought about it, but I was still kind of little worried about last night's volatility before the London Open. And so I didn't, but you definitely can. It's called the go to bed trade. It's a wonderful trade, and maybe that's a trade we'll do after we have the moving average conversation. But the answer to the question is absolutely you can. You can automate a trail stop and ensure you can get in there. Go long on gold, go to bed. I kind of feel like that's every day that ends in a Y, RQ. Like, I just feel a little bit better when gold and silver are leading the portfolio. You know what I mean? Just a little bit. Just a little bit. Just a little bit. Did they beat? Hold on. Just this, that's something I've been anchoring on all day. Oh, guys, we could have something good going into tomorrow. Oh my goodness. Good job, Broadcom. Good job. Good job. Good job. Good job, Broadcom. No. RQ, you can always interrupt my conversation with a Broadcom beat when that was the number two catalyst for me this week. Absolutely, brother. You can take away from the stream all day long because I can get right back into that conversation. I did want to hear that information though, so I appreciate the information. All righty. Maybe the AI trade's not dead. Maybe we get a Nasdaq break. Going to be very interesting. Okay, so back to the kind of the moving averages here. So the 5-9 combo on any time frame is a very good momentum support and resistance zone to both for two reasons. Both for momentum entries, but also if you catch a clean trade, guys. And at the end of the day, you don't know where to target. You don't know specifically where it's going to go. You're breaking out of an all time high, for example, you have momentum, and you're like, hmm, I feel like we have some open air. Where are we going to go here? To me, when I say, quote, I'm a big believer in allowing momentum to play out, ladies and gentlemen. What I mean by that is that's usually because I have a trailing stop loss underneath the 9 EMA on that time frame, and I'm not going to get out of the trade unless the 9 EMA gets breached. Does that make sense, guys? I'll give you an example of it. I'll give an example of it. Who here has been involved in the silver trade at all recently? Okay, Omaro, you have. Anybody caught this silver trade? Okay. Now, I've been in this trade in some way or another, guys, since this candle right here. Since we broke out of that resistance level right north of 30, I've been long the entire time. Now, I've been getting in and out of the core position. I've been adding to it at times. I've been taking away from it at times. But I've held a core holding since this breakout. Now, can anybody tell me why the management tool I have used to stay in this position trade as long as I have? Because if it does not close underneath the 9 EMA, I'm going to be in the trade. As long as it does not close underneath the 9 EMA, I'm going to be in a portion of this trade, guys. That's that momentum moving average. So you might be thinking about it from a day trader's perspective. That's not what this conversation is. It's on every time frame. It's one of my favorite techniques to trail against a 15-minute day trade is also my favorite trailing stop loss against a longer term position trade. It's really not different. Yes, Gabber, I will scale in and scale out based on different technical patterns. On the high base breakout from 2 days ago, I added to the position. I do not have a target here, but when I start to see momentum shift, I will scale out of the position. So basically, what I'm doing is I have a core position trade going on, Gabber, that I also will swing trade the daily chart patterns, basically. And so I swing trade the daily chart patterns while I simultaneously manage my longer term position trade here. And that's how I scale in and scale out of it. But the point is on the longer term position trade, will I ever get out of that as long as we stay above that pink line? No. Now, trading can be difficult sometimes, guys. And I hear from a lot of people that management of trades can be a little bit difficult as well. How many of you struggle on the management side of trading all the time, Omaro? Gabber, let's be honest. Let's have an honest conversation here, guys. Position size. That's a good. That's also one that I think a lot of traders, including myself, sometimes struggle with. Okay, entering too soon. The easiest management technique in the world to do is saying I'm going to be in the trade as long as it stays above the pink line. How complicated is that, by the way? The entry might be different. I'm just talking about management. How difficult is it to say I'm staying in the trade as long as it stays above that pink line? That's not difficult. You can make trading hard, guys, or you can make trading easy. And moving averages, specifically on a support and resistance and a management perspective, they kind of make it easier. And so when you hear me talking about the 9 EMA in our content, in our streams, and so on and so forth, it's the number one momentum indicator for a reason. And the reason that is it's the number one algo program on almost every single time frame. And so it is accurate to suggest I do swear to the altar of the 9 EMA because it smooths out a lot of the momentum. Number one, it does, Becky, no doubt about that. It cuts through a lot of that price action noise, right? We can overinterpret candles quite a bit. Well, moving averages are just programmed based on the average close over time. And so it can really help smooth out some of that noise as well. So that's the faster moving averages. Faster duration moving averages are momentum based. And so when you have momentum conditions, you really want to anchor against those momentum shorter duration moving averages, such as the 5 and the 9 combo. Now, once again, what do we call the combination of the 5 and the 9? We call it the hard 14. The combination of the 5 and the 9 is the hard 14, and that is the support and resistance level we look for in momentum conditions. You also have other duration moving averages that are going to be important on the shorter term side of the equation. The 20 SMA is also a pretty popular short term support, short term trend. The pocket between the 9 and the 20 can also be a more of a standard. Whereas the pocket between the 5 and the 9 is kind of a momentum. And does everybody understand what I mean by the pot when I say pocket? Does everybody understand that term? When I say the word pocket, okay, good, Patricia, you're good. I just want to make sure. The pocket just simply refers to as the vertical distance between two moving averages. That's what a pocket refers to. And so when you're talking about like the pocket between the 5 and the 9, it's going to be very tight because you don't want to give momentum a lot of room, right? You want to be able to track that momentum support level. That pocket's going to be fairly tight. It's not a big zone of support and resistance. When you're talking about, different, the 9 EMA versus the 20 SMA, for example, that pocket is a little bit bigger because it tracks standard retracements typically. So it often can be a good, for example, 38% retracement down to the 20 period moving average, for example. So that pocket between the 9 and the 20 would be considered another bull zone. It's usually a little bit wider because the vertical distance in that pocket is going to be a little bit wider. That's why it's used to track, that zone is used to track a little bit more standard bullish retracements, standard bearish retracements. And so the 20 period moving average on this simple side of the equation would be one of those short-term moving averages that are also utilized to help understand kind of the overall short-term environment, not the momentum environment, but the short-term trend environment. And so keep an eye on that 20 SMA, intermediate to longer duration moving averages. The 50 period moving average, the 100 period moving average, the 200-day period moving average, for example, are used to track longer term zones. For example, there's a trending philosophy that as long as you are above the 50 period moving average, you are in an intermediate uptrend. There's a trending philosophy that suggests as long as you are above the 200-day moving average, you are in a long-term primary uptrend of some capacity. And because they are used that way, they are really kind of sensitive when the price is around those for buyers to really fight for those levels. The investor zone, the 200-day moving average, is a zone that buyers and sellers will defend very aggressively because once it gets above those levels, oftentimes you'll see kind of momentum take over and a new trend will begin. So really kind of not, they're not part of the conversation nearly as much because they are very lagging against the price action. But when the market is around them, they attract a lot of support and resistance conversations. However, they are obviously much slower, and they're not used nearly as much in crossovers, I would say, versus some of those shorter duration moving averages, mostly used in my estimation more just as a support and a resistance gauge, as well as a trend following tool as well. So the pros of using moving averages, number one is they're algo powered. They're all algorithm based. Number two, they give us objective signals. They give us helpful trend confirmation tools, trading signals, momentum gauges. They help us understand a lot of the technical condition. The cons, they lag the market. They're not price action. They use price action obviously, but they do lag the market. They oftentimes can give premature signals. Sometimes they can give false signals as well. You can really overanalyze moving averages on different time frames. It gets overwhelming pretty quickly if you use too many moving averages. I don't like using too many moving averages. I'm pretty structured on that. I use the 5 and the 9 in a momentum condition. I use the 9 and the 20 for a variety of different reasons. I use the 50 and the 200 just to keep them on the chart to understand the overall health of a trend, mostly on the daily chart. I really don't use a lot of the 50 and the 200 on intraday, although that certainly can be done. I use them more on the daily chart. The 9 EMA is by far my most widely used moving average. I don't even want to say there's a close second to me. The 9 EMA is really the epicenter of the momentum condition from a moving average perspective. So, practical applications of moving averages. Number one, candles can be a little complicated to kind of read in the infancy of the candle. They can be a little bit difficult to read when you get 20, 50 different candles together. Moving averages have a tendency to smooth out that price fluctuation. If the 9 EMA is up, short-term trend has momentum. If the 20 period moving average is up, short-term trend is bullish. If the 200-day moving average is down, primary trend is bearish. Moving averages can just be a very simple identification to help us understand the direction of different time frames of trends. They obviously can be act as technical catalysts. And what that means is they can act as a support and resistance. Remember, moving averages, much like almost every other technical catalyst out there, previous pivots, principal of polarity, trend lines, moving averages, obviously, Fibonacci numbers. All of these are catalysts. They can act as catalyst. It doesn't mean they're support. It doesn't mean they're resistance. It means they can act as a support and resistance. We still need to see them act as that way. We still need to see confirmation. Just because the stock is at the 200-day moving average doesn't mean it's a good buy, guys. It means you should start tracking it for potential reversal. Just because the market's at the 9 EMA doesn't mean it's a good buy. It means you should track for confirmation. Co- confirmation is the thing that confirms that they are support and resistance, but they act as catalysts. Catalysts are not guaranteed to be support and resistance. They help us measure momentum. When shorter duration moving averages are expanding above lagging moving averages, longer duration moving averages, you're seeing momentum play out in the market. They can help us understand that story. They certainly can help price confirmations, and you can certainly see violations of moving averages to change trending conditions as well. From the shorter duration to the longer duration moving averages, helping us understand the overall health of a trend. The A trend is in its best condition when moving averages are stacked and expanding on top of one another. As you can see in this example here, you got a big distance between the 50 and the 200. You got the 20 and the 50 in a little bit of a parallel. You got the 9 riding top. That tells you every single duration of trend is bullish. Short-term 9 EMA bullish, 20 period short-term trend bullish, 50 period intermediate trend bullish, 200-day primary trend bullish. Those are your 4 durations of time frames when it comes to trends. You have your short term, i.e., your momentum conditions, that's the 9. You have your short term trend tracking around the last 30 days, 30 around the last month of price action. Each month has about 21 to 22 trading days in it. You have basically that 20 period moving average tracking the last month. That's the short term trend. The 50 period moving average is tracking about the last quarter of data, which means it's tracking the intermediate trend. And the 200-day moving average is tracking the primary long term trend. When all of those trends are rocking, you have a very, very, very consistent trend. From a momentum perspective, you can see moving averages help us understand both candles, obviously, but moving averages can kind of confirm that you see an expansion of momentum. When the 9 EMA is going vertical against your longer duration moving averages, that's momentum, momentum, momentum. When the moving averages start converging to one another, that's a loss of momentum condition. And once again, to me, once you close underneath that 9 EMA, you are now showing the loss of momentum. As long as you stay on top of the 9 EMA, you have a very consistent momentum condition. Once you give up that 9 EMA, you no longer have a momentum condition. You need to start tracking it a little bit differently. For example, as long as you're above the 9 EMA, there are 2 specific patterns I'm looking to trade: high bases and flags. Those are the 2 patterns I'm looking to trade. Flags into the 9 and consolidation with the 9 catching up. That is 2 of my absolute favorite signals in the market. We were just talking about silver, for example. Let's go to, the silver contract here on the daily chart. Look what happens here, guys. You see the expansion on the breakout. You see that momentum expand, expand, expand. Now, if you know something about silver, silver doesn't run hot long. It really never does. It has 5, 6, 7 days in it before you see a secondary pattern. So, for example, you see, for example, right here from the low to the high here, 1, 2, 3, 4, 5, 6 days before you start coming down. 1, 2, 3, 4, 5, 6, 7 days before you can consolidate. You go back even to this very, very aggressive trend here. You got 1, 2, 3, 4, 5, 6, 7 days before it consolidated. After the pivot, 1, 2, 3, 4, 5, 6, 7, 8 days before it consolidated. On the break with momentum, 1, 2, 3, 4 days before it came right back down. Silver is not one of those asset classes, and not every asset class is that behaved, but it really has like 5, 6, 7 days before you see a secondary pattern set up. And so when silver ran hot here and we talked about this literally in Power Hour on that front run conversation, but once it did really kind of get above that 52, 1, 2, 3, 4, 5, 6, 7 days, and then all of a sudden you start consolidating. And it was not surprising to me that once the 9 EMA caught up to it, you see it kind of kiss right there. Once the 9 EMA caught up to it, all of a sudden, and the 9 EMA catches up not when it hits the price, it catches up when the 9 EMA is at the bottom of the base here. And so you see the bottom of the base right there. Once that 9 EMA is there, that is a giddy up and go sign almost every single time in a high base, because a lot of times that 9 EMA is just going to catch up to the price. And once it catches up, buyers have been alleviated a little bit. The slight overextension has been alleviated a little bit. And then all of a sudden you're ready to rock and roll again. And now we got 1, 2, 3 days into the breakout, probably see another couple days of expansion. And then what am I going to expect? I'm going to expect either a pullback. Let me get the line here. I'll expect a pullback down to the 9 EMA, or I will expect a high base to consolidate while the 9 EMA catches up, and I'll trade that next pattern as well. And so, the 9 EMA here, it's not just the pattern I'm looking at here. It's the pattern, i.e., a high base after a momentum breakout, and it's just sitting there consolidating, just coiling, just waiting for that 9 EMA to come up and say hello. That 9 EMA gets above that 57 level. Not surprised to see that breakout the next day and see the continuation of the expansion there, because that a lot of times, again, that's the anchor I'm waiting for in pattern development. I'm a pattern trader. I need to see those high bases. I need to see those flag based patterns. I want to see them kind of around that 9 EMA. Once that catches up, boom, high base ready to giddy up and go. Once a flag comes down into the 9 EMA, once again, pretty good signal, ready to giddy up and go. And so the 9 EMA, once again, kind of helps me understand the totality of the momentum condition. And as long as we're just riding that 9, like every time it develops around that 9, I'm going to have some interest until that changes. One of the most popular ways moving averages can one of the most popular ways we use those moving averages is, just like I said, acting as that ultimate catalyst for support and resistance. A lot of times, again, you come into the daily chart on the SI. You look at that 9 EMA on the daily chart, caught up to that high base breakout, looked great. You go into the weekly chart, developing situation on the weekly chart, that consolidation, that cup and handle we were tracking on the daily chart. Well, guess what that cup and handle did? It just developed until the 9 EMA, boom, caught up, boom, ready to rock and roll. And so regardless of the time frame you're looking at here, you look at that 9 EMA on the intraday side on the 30-minute chart. Once you break out here, it rides that five, stays above it. Once you close underneath the 9, you got a little bit of a different condition there. And as you closed underneath the 9 here, guys, guess what? The momentum's now gone. You had momentum all day here in silver, up, 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 all day. Once you closed underneath the 9, momentum's gone. Momentum's completely out of the equation, because it's not just me. That's algorithms. Once you didn't hold here, traders aren't going to come back in the immediacy and just say, "Oh yeah, we now got our price." No, you got to see that redevelop into a better pattern to get back into a momentum condition. Where would you have closed here? If you were riding this momentum, and I was not on silver, but if you were riding this momentum, my stop loss would have been trailing on the 15-minute 9. And so I would have got stopped out here. Guaranteed. Guaranteed. It's a tried and true method for me on any breakout condition that is developing on any time frame outside the 5-minute chart. Like if it's a breakout on the 30-minute chart, if it's a breakout on the hourly chart, if it's a breakout on the 15-minute chart, I will I will use the 15-minute 9 EMA as a management gauge, probably upwards about 90% of the time. So to me, that would have been a management, but I didn't trade silver today. I just have my swing trade going on silver. Now, the question though on my swing trade, am I doing anything with my swing trade? Have I aggressively trailed up my stop loss on my swing trade there, Gabber? Because I didn't day trade silver here. I have a position trade going on and I have a swing trade going on right now. My swing trade stop loss is right here. It's right underneath this breakout channel, right underneath the 9 EMA. That's where my swing trader stop loss is right now. Once I see the candles start to shift momentum, I'll be a little bit more aggressive on that swing trade. My stop loss on the position trade is all the way down around 53. I won't get out of this position trade that I've been running forever until that happens because I don't think we're done cooking yet. So I'm not going to choke that off yet. But on the day trade, it would have been on that 15-minute 9 EMA. Next week, what we're going to talk about is we're going to talk about the three P's of moving averages: pockets, pulls, and pinches. The two I really like are pockets and pinches. I do love me a good old moving average pinch, and I love me a pocket of clean air. And we'll get into that conversation a little bit next week. But for this week, did that conversation on moving averages help you understand how to use moving averages a little bit more? Nacho went from a -10 to a solid 5. I love it, Nacho. I love it. Does anybody have any questions? Yeah, Aaron, I'll get this posted probably on Saturday. I'll get it up on Saturday on YouTube, and I'll post the link in Discord when I do. Well, you're more than happy, more than welcome. If there's one moving average I would put into the playbook, it would be the 9 EMA. That 5-9 combo on momentum is pretty powerful on a lot of different time frames. Now, there's other ways to use moving averages that we haven't got into here today. Um, like we'll get into a little bit of that next week with pockets, pulls, and pinches. Maybe we'll do crossovers as well. All righty, team. Well, that is all I had for today. Thank you so much for hanging out with me in the lab here today. And obviously, if you need any help between now and next lab, well, hit me up in Power Hour or hit me up in Discord. Thanks, Tim. You are more than welcome, Nacho. I appreciate you as well. You're welcome, Gabber. Later, Tim.